What's up, everyone? My name's Robbie. This is Robbie Manila, and today we're going over your questions about the bear market. So I threw this poll up on the channel the other day. I said, hey everyone, planning on doing a video about the state of the market / how to invest in a bear market. Let me know if you have any questions. And I got some really good questions from you all. I want to really say thank you so much. I really appreciate when you answer those polls, when you comment about anything. I just really like when you do it. So thank you so much. And if I do more polls, please throw those comments in again. If you like this video, hopefully we'll go over some more of these. Let me know if you like it in the description below, so I know and I can do more videos like this where I can answer questions that you have. I'll poll the audience. You can type some stuff in there. So anyway, let's go ahead and let's go through some of your questions. Thanks everyone so much for watching. I do want to remind you, I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence. All right, let's go ahead and get started now. Remember, I do have some affiliate links below if you want Barron's newspaper. If you want some other stuff in the description, take a look down there. Support the channel, appreciate that, and hit that like button, subscribe if you want to see more videos like this. And continue answering my polls and asking me questions so we can do more of these videos. So, of course, I've read these comments, but I haven't really prepared anything on these, so I'm gonna go off the cuff, as they say, right? So let's start with Baron Wolfgang. Awesome name, by the way, Baron. What would you be looking at accumulating based off current market conditions? Would you wait for more downside before buying? If you were to acquire 5 to 10 stocks, what would they be? No ETFs. So Baron, awesome question. Thank you so much. Of course, by the way, these are my opinions, right? I am not going to know what you do. I don't know your risk tolerance. I used to be a financial advisor. I would sit down and we'd do a risk tolerance questionnaire. I would see how they felt about investing. I would see their assets, where they are. And I'd do all that stuff and we'd figure out like what they should be doing, right? I don't know you. I don't know anyone who's answering these questions. What I will say in general, if we start off with that first little question of, if you had no stocks at all, would you be looking at accumulating based off of current market conditions? The answer to that question is I would definitely still be buying off of current market conditions, like I showed you in that last video I made, and I'll show you again real quick. So right now we're looking at 2008, right? This is 2008. This is December of 2007, this is 2008, this is when things started going south in May. And so like I said in that video before, if you bought here, let's say October of 2008, you were seriously early, the market still fell a lot, right? So what happened? You bought in October, the market still went down, let's say over 30%. So you still lost 30% since October, but then you waited it out and you kept in the market and suddenly you're up, and this is the S&P 500 by the way, and so suddenly you're up. By April of the following year, so just a few months later, now you're up 15%. So if you had just done that, if you had just started buying and then held over a few months in 2008 during that terrible time period to invest, you would have still made money during that time period, right? And if you zoom that time out from October until, let's say, what time is this? Let's go into February of 2018, right? I'm just random time period. You're up 170%. So obviously, it was a great time to be buying stocks. Of course, buying the correct stocks. This is the S&P 500. You can always invest in the S&P 500, which I know you said you don't want to know anything about ETFs specifically, but you can always invest in the index and be pretty confident that buying and holding is going to work out. It's individual stocks that you don't always know. So if you're going to go with the stock that is losing money, right? So those stocks right now, they're not in vogue, let's say. They're not what the market is really rewarding people for. And I don't know if it's going to reward people by the end of this year. I don't think it is. So I think these high-flying tech stocks that were really having crazy valuations, I don't think they're going to have great times going forward for the year 2022. Now, a year from now, I could be completely wrong. And so if I'm going to be accumulating stocks right now for myself, what I'm doing is I'm saying, well, first off, what's my risk tolerance? Am I okay if my stocks continue to go down another 30%? Because if I'm not comfortable with that, I'm definitely not buying stocks I think can go down another 30%. So that situation, I'd be in more conservative stocks. Right? I'd probably be in like dividend paying stocks, like long-term dividend stocks have been around for a long time. Talk about like things like Procter and Gamble or Johnson and Johnson, things like that, right? So I don't love the valuation, for example, of Johnson and Johnson, but I know it's a dividend paying stock that probably isn't going to lose too much value. If I was okay with more risk, I would take a look at the stocks that I think are undervalued. And so I've gone through in this channel multiple different stocks, of course. Some stocks I know that I've made that I think are probably undervalued still include like JP Morgan. So we're talking banks, JP Morgan, Bank of America, I think are decent buys. I think in semis, I think Intel is a good buy right now. I think AMD for semiconductors is a good buy. But semiconductors, I don't necessarily think that it's going to do well maybe over the next year or two, because I think if there is a recession, that semis aren't going to do that well. Now, there might not be, and semis might do well, right? So again, it comes down to risk tolerance. I also like companies like PayPal right now. I think PayPal is a decent stock. I think also Facebook, aka Meta Platforms. I think Facebook is a good company. That's also way down, but the sentiment for these companies is very bad and it's going down. And so this could be a bad thing to invest in right now because there's negative sentiment. But of course, if you have a long-term view, investing in a company that has good cash flows like those two I just mentioned, it could be okay. Hope that makes sense. Okay, on to the next one. So we have Raul Sharma, and thank you very much, Raul, for the question here. So I have VOO, SCHD, and QQQM. Nice. What is the ideal percentage of these ETFs in my portfolio for long-term wealth generation? So I'll say this in terms of like what I would prefer for myself. So in terms of QQQ, which by the way, QQQM, I'm pretty sure I think, let me know in the comments below if I'm wrong about this, but I think it's just a variation on triple Q. It's got a lower expense ratio. Triple Q is the NASDAQ 100 index. And then we have VOO, which is Vanguard's S&P 500 index. So that tracks the S&P 500. SCHD is the Charles Schwab High Dividend Yielding ETF. That one is a great ETF that I'm sure a lot of you probably know about. If you watch my channel, I've made videos on it. If I'm a long-term investor and I'm okay with risk and I don't really need income, I don't care that much about income, I would probably want less money in SCHD than QQQM and VOO. I would want to have I would want capital appreciation. If my time period's like 15, 20, 30 years down the road, then I want capital appreciation more than I probably want dividend income. Now, there are dividend investors who have like lower risk tolerance, right? They just really prefer to have the dividends in less stocks that are less volatile, essentially. And you can measure volatility by beta, right? So lower beta stocks that have good dividends, a lot of dividend investors love stocks like that. So if you're that type of investor, I don't think you're going to make as much money long term if you, for example, invest in SCHD and like don't have as much in VOO and QQQM. I think those will do better longer. But I think if you want to have less, let's say, volatility, maybe do better in down markets and have that dividend yield, then of course SCHD is good. Me personally, I would have, let's say, 10% SCHD. I'd have, let's say, VOO. I'd split VOO. I have more in VOO than NASDAQ, just because I actually prefer to have more, I think, in my opinion, more diversification in industry or sector, let's say, and industry than NASDAQ, which is more tech heavy. Even though NASDAQ probably will maybe outperform it over a longer period, I would still kind of like to have that diversification that I get in VOO more. So I think I'd probably go with 60% VOO for myself. I'd go with 30% QQQM, and then I'd probably get 10% SCHD. That's what I would do for myself. Okay, so Luis says, thanks Luis. I know that you've commented before, and I did a video on one of your comments. Thank you. So, hey Robbie, about consumer staples sector, can you explain the down? Is the consumer staples sector down? Actually, I don't know that. I thought it was up. Wait, let me take a look. Okay, so yeah, VDC, I guess what I always look at is how I'm doing, how my ETF, sector ETFs are doing versus the S&P 500. So yeah, I'm out, my consumer staples ETF with VDC, which is what we're looking at here, Vanguard Discretionary, is outperforming the S&P 500 because S&P 500 is down like almost 20%. So yeah, that makes sense. So yes, this is down 9.5, 9.15%. I would say, like, think of this in context. Let's overlay this with the S&P 500. So I'm using SPY here. So S&P 500 down 18.4%, and VDC down 9.15%. This is year to date. So why is the consumer discretionary sector down? Well, generally, I think it's because probably valuations and interest rates and inflation. Now, one of the reasons why consumer, some staples, I don't know if I did say discretionary, consumer staples is a decent place to have money during a recession is because these are consumer, they're staple goods that people will often purchase no matter what's happening. So for example, I'm going to buy toothpaste. If there's a recession, I'm still going to brush my teeth, you know? There are things I'm not going to stop buying. So Colgate is probably going to continue to sell toothpaste, right? So these are little things that may still get dinged, let's say for valuation purposes, because interest rates, let's say, are starting to go up. And now valuations go down a little bit because, let's say, growth might stall, or let's say inflation might start hurting profitability or things like that. But generally, the reason why you see that consumer staples is down but still doing better than the S&P 500 is likely because of reasons like that. And also, by the way, it really held up until the 18th of May. So it really got crushed at that time. Anyway, I hope that kind of answers your question. Okay, next up we have a question from McLeod. McLeod. It's my Scottish accent. McLeod, aka Doom. Okay, so can you do a review of TBT? I'd like to hear your thoughts on the ETF. I'd also love to hear any ETFs called political figure investments. Political figure investments, actually, I don't know anything about ETFs that follow political figure investments. I don't follow any of those. Sorry about that. TBT, very interesting. So this is for everyone to understand, TBT, this is the website of the ETF. The ticker symbol is TBT. It's the ultra short 20 plus year treasury. So TBT uses so per shares ETF seeks a return that is negative 2 times the return of the underlying benchmark target for a single day. So what's going on with TBT is they're basically using leverage. They're going to try to double the return on a single day of the index that it tracks. TBT, like it says here, it's 20 plus year treasury. So what you're looking at here is you're saying this ETF is taking basically longer duration treasuries, so debt instruments, let's say bonds, and it's saying, well, and let's go over the reason why people like this right now. As you probably know, maybe you do, maybe you don't if you're not into bonds. So basically there are 2 things you need to know on bonds. Well, there's a lot of stuff you need to know about bonds. I'm not a bond expert, by the way. I did have to learn a lot of this stuff when I was an advisor, but in terms of bonds, basically what happens is you have interest, of course, that the bond pays you. You have coupon payments, and then you have the price of the bond. Now, when you go to buy a bond, you buy it for the price and there's the coupon, right? It's going to pay you this much forever. But if you go to buy a bond, let's say on the secondary market, after it's already been issued, I own the bond, I'm going to sell you my bond that I already own. Well, now we're talking about what's the price of the bond as well, based on premiums and discounts. And so I don't want to get you too confused here, but the bond's price, if the interest rate of a bond is 3%, and let's say interest rates go up, suddenly the interest rate of the bond is not looking as good. So the price is going to go down. And this is going to happen over time as interest rates probably go up, at least in the intermediate term, for example, while the Fed raises interest rates. And who knows, maybe it's longer term, but as the Fed raises interest rates, longer term, longer duration bonds are going to lose price, because these 20-year bonds are going to now not look as good comparatively as the yields start going up comparatively to the bonds. And when this ETF is trying to take advantage of that and say, I'm going to short, or I'm going to make money as these 20-year longer duration bonds start going down in price. So as they go down in price, this ETF actually makes money because it's inverse. Few things I don't like about just generally this. I like the idea. I love the idea. I think it's actually interesting, an interesting idea. It's obviously worked. So here we're looking at year to date. This is how this ETF's done. It's up 40% year to date. So Obviously, much better than the S&P 500, SPY on here. Let's show you. SPY down 18%, TBT up 40%. So obviously, it's been a good strategy. Maybe if you wanted to add some of this as a hedge in your portfolio. The thing that I don't love about this is, number one, I don't like leveraged ETFs. I don't like how they end up resetting daily and what that ends up doing to a portfolio. There's like slippage when this happens, and you can easily lose your money pretty quickly. And so you really have to get the trend right, and if you don't, you could definitely get wrecked. And so whenever if I was to go and get into this, I would be wary of the trend, right? So is the trend continuing to go up? I mean, I probably will, but if it doesn't, then you're gonna get wrecked, right? It's leveraged 2 times, and if it goes up, it's gonna go against you basically, right? Because this is an inverse ETF. So basically, I would stay away from it myself. I understand why some people would really like this. I think it's an interesting idea. Obviously, it's probably worked out for a lot of people. But for me, I'm not really trying to make a, in my opinion, I think for me, the risk of this is, doesn't give me what I want. Like, I could have bought energy, like I liked energy, for example. I'll show you. So XLE is an energy ETF, right? So I made a video on energy. I liked energy at the start of this year. Energy has done just as well as this. So I thought energy was undervalued, and I thought it was going to be a good place to have money. And yeah, so I would rather like try to pick things that I think are going to have more tailwinds or do better in this type of economy than like something that's going to bet on interest rates and then need to give me like twice the leverage, essentially. Hope that makes sense. But very interesting idea, strategy. And, small amount of money, it could be an interesting hedge. Fernando, always commenting. Thanks, Fernando. So what do you think about the GOP-led bill influence in Facebook and Google? I think there's always been a risk to antitrust with Facebook, Google. Microsoft definitely had it back in the day. I mean, there was a lot of talk about it back when Bill Gates was running Microsoft. I kind of just, at this point, have swept it under the rug of my thinking, because I don't know, I've heard it so long at this point in time. Like, I remember watching news channel, CNBC and stuff like that 10, 15 years ago, and they're talking about the same thing, and it's never happened. So I guess I don't really feel like there's a big issue there. I don't think that prices are really getting hurt because of them, right? So they're not going out and price gouging you. I think in general they might actually be helping out, because they've helped, let's say Google's helped ad rates for digital advertising, right? It's cheaper than buying a commercial on cable. I think it's hard to kind of get that argument that these companies are really hurting pricing power and really hurting consumers, essentially. So I'm not too worried about it myself. Okay, last question, Cocoa Leaf. Cocoa Leaf 2020, the first bear market. Looking forward to your video. Okay, hey, that's not a question, but thank you, Cocoa Leaf. Hope you like this one. So anyway, that's all I got for this. If you like this, let me know. I will do more of these. If you don't like it, let me know. I won't do it again. I'll never do this again if you hate it. So that's all I got for today. Watch another of my videos coming up on the end screen right now.